You're listening to the Infinite Banking Mastery Podcast. Did you know that you could build a tax-free pool of wealth that's liquid and accessible all your life while building your retirement nest egg? Gain full control of your financial future and stop relying on the government and banks. The wealthy have already discovered this wealth-building secret. Now it's your turn to get financially secure without following the conventional wisdom that keeps you in debt to banks. Now here's your host, Valerie LaRocque.
Hello, everybody. Welcome back to the Infinite Banking Mastery Podcast. Thank you for listening in. I thought I would continue this week on the topic of rate of return and whole life. I wanted to expand after last week's podcast on the discussion of rate of return, as I've spoken to a few people in recent weeks who brought this topic up, and it does come up from time to time. So I thought I would go into it a little more. I think it's easy to have rate of return front of mind when looking and comparing investments, but we need to think of it differently when we are discussing a life insurance policy. Whole life policies, remember, are assets and guaranteed assets as well. And they are not the place to go looking for rate of return just in general, which is one reason why I would never help someone with the infinite banking concept and a variable universal life policy, as those types of policies are combining investing with your life insurance. And in my opinion, is just more expensive life insurance with the risk of losing your policy completely. Both the cash value and the death benefit can be lost. Keep in mind that every vehicle you invest in has only a projected rate of return. It has no guarantees. Only whole life comes with guarantees. And when wanting to know the rate of return on your whole life policy, well, maybe if you could tell me how you will use the policy every single day for the rest of your life, then I could give you a more accurate rate of return on the policy. Kind of like in the game of golf. It's not about the club that you're using, it's about the swing. It's not about the rate of return on the policy, it's about how you use the policy. It's not about the growth of one whole life contract. It's about taking over the banking function in your life, which is likely to create a system of policies. Remember that whole life is the holding tank for your capital. When you want to get into a new investment, that capital is going to come from somewhere. You will have to deploy cash from somewhere. So where will you deploy that cash from? My opinion is that running those funds through a policy first before deploying them into an investment that you believe will give you a great rate of return is the way to go. The infinite banking concept is about flowing your money like the bankers do. It's about doing what banks do as opposed to what they're telling you to do. It's about cash flow and helping you to own and control more of your own capital. When it comes time to retire, you don't retire on rate of return, you retire on cash flow. And the other thing is, you can't always depend on rate of return because you have no idea what it will be. You have no idea what the ups and downs of the market will do. I once sat at an event when I was working for Merrill Lynch years ago, almost 20 years ago. And the speaker said something that really stuck with me all of these years. This was after the catastrophe of the market in 2008. The speaker that day was Nick Murray, very intelligent man. He has written numerous books and has been in the financial services industry now for over 50 years. He's a stock market guy and always speaking to financial professionals, financial advisors. He's talking to advisors rather than the public. So he had said the simplest thing about the market to a room full of financial advisors who were all hanging at the edge of their seat to learn what he had to say. He said, "I don't know what's going to happen in the stock market tomorrow, and neither does anybody else." And I mean, so true, right? Nobody knows what's going to happen tomorrow. And so we can do our best job of due diligence and coming up with an investment portfolio that would be good for you specifically, according to your risk comfort level and all of that. But the fact is, We could set you up with something that's great. It's done great historically, all of that. But we don't know what's going to happen tomorrow. It could do the exact opposite of what it's done for 20 years. Nobody knows. You might look at your retirement account returns and be happy with them. But do you know the real return on your investment? Because if you recall from my podcast or go back and listen to it, actual versus average, the real return is different than the historical averages shown on your statement. And sometimes people don't consider the fact that their account is increasing, partially because they've been consistent about funding that account. They are making regular contributions to their accounts, which helps the balance to be consistently higher. There's so much value in the infinite banking concept and using whole life as the vehicle. Think about creditor protection. In most states, your whole life cash value is protected from creditors. Well, what's that worth to you? You might be thinking, you'll never be sued. But of course, it's a possibility. It's always a possibility. These days, I'm concerned about my 16-year-old who's about to be licensed. I've been trying to postpone it as long as I possibly can due to all sorts of reasons. But I'm thinking lately, okay, we got to give him car insurance. Is my umbrella coverage high enough? What if he were to get into an accident and really hurt someone? What if the other driver was a brain surgeon and now he can't work and wants to sue us for lots of money? Got to make sure your umbrella coverage is high enough, as you just don't know what tomorrow holds. When someone wants to compare rate of return on a whole life policy to an outside investment, my thoughts are, well, what do you think the rate of return will be on that investment in your retirement years once you have to start pulling money out? Well, it wouldn't be possible to figure out because we don't know what the future tax brackets will be or which one you'll be in. And when your interest was first piqued on this concept, the infinite banking concept, when you first heard of it and started to learn and look into it, was it the potential for rate of return that drew you in? Most likely it wasn't. It was probably more about what the policy and the process of IBC would help you accomplish. Now, if rate of return is top of mind for you and it's still too hard for you to think of whole life and how you could probably get a better rate of return somewhere else, then you could always think of adding a whole life policy as being a part of your diversified mix of assets, as being the conservative part of your portfolio. Most portfolios have a mixture of stocks and bonds, and you could consider this taking the place of the bond part of your portfolio, the conservative part. Always keep in mind that rate of return will be different for everyone practicing IBC because everyone does things different with their contracts. They fund differently, borrow at different times, some more often than others. Some treat themselves like an honest banker more than others and pay themselves back regularly. Some pay interest only. Some pay interest only once a year as opposed to once a month. Some take a year off and then begin a repayment plan or pay the whole debt off. All of these things will affect the rate of return on your policy. But that's not what's important. What's important is what the policy allows you to do. That it allows you to buy other cash flowing assets or to eliminate paying tons of interest to banks, which is going to help your net worth. It allows you to access your cash value income tax free while your cash value account continues to grow, while your tax-free death benefit is also growing, protecting your cash value from creditors in most states anyway, and giving you access to a portion of the death benefit for a critical, chronic, or terminal illness. One of my favorite Nelson Nash quotes, you finance everything you buy. You either pay interest to someone else or you give up interest that you could have earned. Every asset you have purchased in your life, you bought with capital from some account. Was that capital account making you money or was it making someone else money? So when someone asks me what the rate of return is, I'm usually thinking, compared to what? What are we comparing it to? And if that's the main focus when looking into IBC and whole life, then the focus is on the wrong thing because we don't go to our whole life policy for high rates of return. We go to our whole life policy for stability, guarantees, and the ability to earn on the money we are deploying elsewhere, just like the bankers do. In addition, dividends on policies with all companies will look different over time. The illustration is just that. It's an illustration. It is basically guaranteed not to happen, not to look exactly like what you receive the day you open your contract. It is just their best projection at the dividend rate that they will pay into the future based on today's rates and whatever they think will happen. So rather than focus on dividend rates with different companies and illustrations, which again are basically guaranteed not to happen, remember that your actions are the most important. If you're working with a mutual company and a whole life policy, you're in the right place. Just want to make sure you have an advisor who will be a good coach for you. So I hope this was a helpful topic. As always, go ahead and reach out to me if you'd like to work together. If you'd like to review or like me to review your personal financial situation and goals and begin the process of becoming your own banker. My email is valerie@alphaomegawealth.com. I hope you have a wonderful week.
This is thepodcastfactory.com.